The corporate bond market is in serious trouble if the bears are to be believed. The US economy is about to be swept away by a tidal wave of corporate defaults, says SocGen perma-bear Albert Edwards. Fully $1 trillion of debt is heading for distress over the coming cycle, warns UBS. The zombies are coming. Certainly, the market has soured. Default rates are up by about 70% over the last year and are on track to surpass their long-term average for the first time since 2010. Markets are bracing for much, much worse from here. But is this sector really in such a dire state? Is it really a canary in the coal mine, warning us all of the next big macro risk to come now that the Fed is taking markets off the drip? On balance, probably not. Almost all downgrades and a thumping majority of defaults are in oil and gas and energy, for very obvious reasons. The US dominates. Oil and high-yield bonds have been moving in lockstep over the past quarter, particularly during spells when oil has been especially under the cosh. If you strip out oily borrowers, the default rate is running at a post-crisis low. If oily defaults infected the rest of the market, they would be a serious worry, and that could happen. Poor liquidity could force investors to sell more solid paper if they can't get out of troubled bets. Or, more seriously, stress in the energy sector could lead to mass layoffs and a wave of defaults in, say, real estate. But that would be a symptom of full-on recession in the US, and there are a few reasons to seriously suspect that's heading our way. If it does, then the high-yield bond market will be the least of our worries. For now, it's worth keeping an eye on this and just treading very carefully on oily credit.